Welcome everyone. My name is John Novak. I'm the developer of the T3 Fibs Pro Trader for NextGen Software Services. And in this video, I'm going to go through everything you need to know to maximize profits with high reward, low risk setups. So first, we're going to go through a disclaimer, standard disclaimer. Take a second to read that. Now I want to go through my goals for this video. I want to give you 100% understanding of what our indicators are telling you. I also want you to walk away from this video with 100% understanding of the trades that you should take using NextGen software. And I also want you to really understand how you're going to profit with very low risk, high reward setups. Now we're going to go into some things and we're going to really talk about trade setups and indicators. And if you visit our website at nextgent3.com, I'm going to go through this video with the understanding that you've already watched the first video, which is the indicator terminology and the basics of what we do. So when you go in and you watch this indicator terminology and futures basics and any of our YouTube videos, really make sure you click on the cog down here and that you select the highest definition available for the video. This will give you clear view of the indicators on the chart and also will allow you to go full screen. So make sure you click the full screen button, make sure you click high def, and you're going to get the most out of watching the videos. Now there's the second video that you're going to see on our education page. We're going through this video with the assumption that you've already watched the second video as well, which is reading multiple time frame Fibonacci areas using multiple time frame trigger lines. Very, very valuable lesson, a very in-depth discussion of whether Fibonacci support or resistance areas should hold or whether they should break. So please make sure you've watched those two videos before you watch this video. Now, the keys to successful trading. Get in with the least amount of risk and get out with the maximum amount of profit. And if you do have a loss, lose as little as possible. And I truly believe that if you can repeat these things as many times as possible in a day, you're going to have the most success as a day trader. Which brings us to, conventional wisdom, right? Buy low, sell high. And, the cold hard fact of it is most traders out there cannot consistently know what low or high is. They can't do it with any degree of accuracy. And what we're going to teach you is really using our multiple time frame Fibonacci support and resistance areas and combining those multiple time frame support and resistance areas with the trend of the market. We're going to give you low and high turning points in the market. We're also going to go a little further into trading breakouts and trading some other opportunities as well. So we're going to get into some specifics on rules. Now, what I'd like to start everybody out with is a simple thought. Fibonacci areas are either going to hold or they're going to break. Pretty simple, right? Now, we have rules, and when you watch through the video using multiple Fibonacci timeframes and multiple triggers, we have rules on predicting in advance when an area is going to hold or break. And we have rules that we're going to go through and taking advantage of both areas that are supposed to hold and areas that are supposed to break. Now, with new traders and new traders that are new to NextGen, right, we like to have you focus in on what we call best look trades, right? And you really have to start out with our software and have one simple look that you can fall back on immediately. You can learn it in minutes and you can be very confident that you're going to be able to use this setup. And this setup, affectionately we call it the best look trade. And the visual of this trade and the rules of this trade are very, very simple. I didn't even have to write out rules. We're just going to take a look at these rules in pictures. So we're going to look at the S&P E-mini. And the rules are going to be very simple. And you can see with this yellow arrow, we have a background color change from red to green. So the rules are very simple. We're looking for a green background. We're looking for our synthetic trigger lines, which are our cyan lines right here, to be level, meaning traveling horizontally across the chart. Now, it's also a benefit when our fib to fib oscillator is at the 25 buy line. And we're going to look to buy at the support area when we have this condition. So it's very simple. The rules are green background, synthetic triggers going sideways at the area, buy the area, and that's your long trade. So let's take a look at a short trade. And again, this is the S&P E-mini. And again, I want you to really focus on the simplicity of what we're doing. Red background, resistance area with synthetic triggers that are going sideways. And again, keep in mind, you have two sets of synthetic triggers. It doesn't always have to be the first one. It can be the second one going sideways at the area. We're going to look to initiate a short trade at this area. Notice also our fib to fib oscillator is at the 75 sell line. So the rules for longs and the rules for shorts are the same, just the colors obviously different. So again, S&P E-minis, you can see the market trades up and the background color turns green. We pull back to a Fibonacci area. We have our synthetic triggers going sideways. We're going to look to buy at this area. You'll see there's a second buy on this chart where we trade up and we're trending up, and the market pulls back to our mid-band that also has synthetic triggers trending sideways, horizontally on the chart. That horizontal synthetic trigger is the key for you to know that the area that's involved with that horizontal synthetic trigger is your price. And we'll get into management a little bit later. So I just want you to be able to visually recognize the areas that you're supposed to be getting in at. Again, trend is down on the S&P. The market pulls back to synthetic triggers that are sideways at Fibonacci resistance. The market trades down to support. Once we get to support, you'll see the market pulls back to Fibonacci support. With our synthetic triggers sideways, we're looking to buy the support area to take it back up to resistance areas. Very, very simple, very easy. You guys already know the rules. So we'll just look at a few more examples. S&P, market's trending up. The market pulls back to our mid-band, our 165, and the top of Fibonacci area. Synthetic triggers are sideways at the area. We want to buy at that area to give us our low risk, high reward trading opportunity. We'll keep going forward. You're going to see the same thing. Red background. Market pulls back to Fibonacci resistance with the synthetic triggers traveling sideways. Looking to sell at the Fibonacci resistance area. Again, to take this a little further, and you'll see the trend changes to down. The market pulls back to Fibonacci resistance. Now, this is one of those cases where the synthetic triggers haven't quite crossed over, but they've pinched together really, really tightly, which gives us a good opportunity for a low risk, high reward trade setup to the short side. Again, notice our fib to fib oscillator at the 75 sell line. Notice strong market action through the support area, pulling back to what will be our resistance area. And important to notice red background and synthetic triggers traveling sideways at this Fibonacci area tells us that we're going to trade down to the next support area. Again, as you guys watch the other video, which is the multiple time frame trigger lines and multiple time frame Fibonacci areas, you'll recognize very clearly that when our synthetic triggers break through support, we anticipate support to turn into resistance. So we can take advantage of this area from the spot. And the reason we can take advantage of it from the spot is because we've got our larger synthetic triggers traveling sideways at the resistance. Now, this also works in crude oil. Actually, it works in every market on the planet. You can see the trend change to the downside with the yellow arrow. You can see the market returning back to synthetic triggers going sideways, giving you a very small window for a short opportunity from 44.87. Obviously, you can see the outcome of that trade setup. We'll look at that again from the long side on crude oil. Right, the trend changes to green. The market pulls back to your midband with the synthetic triggers crossed up, and the synthetic triggers are sideways during the pullback, giving you really an exact spot right at 44.77 where we're going to look to initiate a long position. We'll look at another example of this. Again, the market breaking through support, pulling back to resistance with synthetic triggers going sideways at the resistance area. We're looking for a short trade. Also worth noting that all of your triggers are beyond and below the resistance, giving it a lot more power to take it to the downside. But you can see a very, very simple, easy to recognize plan on background color, synthetic trigger sideways, look to sell or buy the area with the background color. Here it is again, right? You'll see background color, sideways synthetic triggers at support, background color changes to red, sideways synthetic triggers at resistance. Very, very easy to spot. One more for you on crude oil, and you can see the market trend, background color changes to down. You recognize resistance with sideways synthetic triggers at resistance, giving us a very nice short opportunity with our Fib to Fib oscillator helping out as well. Now, if you trade Forex or you trade stocks or you trade any other markets, the rules are going to be exactly the same. Trend change on the background color to red. The market pulls back to resistance and sideways synthetic triggers to the downside, and you're going to get short on your Forex market down towards the next support. So we've seen S&Ps, we've seen crude oil, we've seen Forex. The same thing works on stocks. It works on larger time frames, smaller time frames. The thought process is the same. What makes it the same? The bar structure that we use, the dynamic Renko bar structure, creates bars that are identical size and shape, no matter what market you trade. So it allows you as a trader to be very consistent in your reading of the indicators and consistent in the application of Fibonacci support and resistance areas. Really what happens is once you learn this simple method, you can trade it on any market or any time frame that suits your trading plan. Now in this next section, I want to go through Fib to Fib, divergence, and also the background color. So we're going to discuss the Fib to Fib oscillator and how we use it. We're going to discuss how it changes the background color, and we're also going to see some entry and exit opportunities using the Fib to Fib oscillator. So the first that you've already seen many times in the prior examples is when our Fib to Fib oscillator is at the 75 sell line, when the market is background color is red, we typically have selling areas. When the Fib to Fib oscillator is at the 25 buy line, we also have potential buy areas with a green background color. So pretty simple read with that one, but very, very powerful and very effective for trend trades. Now, the other thing that we have that you will see on your chart is what's called divergence, and you'll see divergence 1 or divergence 2. And recognizing this pattern is very beneficial for you. And the pattern's very simple. The fib to fib oscillator itself starts out at the oversold level, travels up to at least the 75 level, pulls back to the 25 level, and then the market makes a pivot. And typically when you get divergence and the small triggers are rolling over, that will change the background color from red to green or green to red. Now, if you were in a short position, and you can see obviously where there was a couple of short opportunities from resistance and sideways synthetic triggers, the divergence tells you that the party's over, time to exit your position and look for new trades. Now you'll see the same thing, divergence number 1, this is just a bearish divergence, so it's at the top of the pattern. But the pattern is the same. It's overbought fib to fib oscillator. The oscillator travels down to at least the 25 buy line. And then the oscillator gets back to the 75 line, and we put a pivot in price, and you'll see that's a divergence number 1 pattern. And anytime you see divergence at support or resistance, and it changes the background color, typically our traders will use that as an opportunity for trading in the direction of the divergence. Now, the other divergence that you're going to see labeled on your chart for you is what we call divergence 2. And we just call it divergence. We don't really differentiate between 1 or 2, but I want you to understand the difference. Divergence number 2 is, double bottoms or double tops, depending on direction, obviously. And the fib to fib value on the oscillator itself travels from oversold and only makes it to the 50 line. And then it pulls back to the 25 buy line and then makes a pivot. So, again, this is very powerful if you were in a short trade from the midband and your synthetic trigger sideways, which would be a very valid trade, right? Divergence is going to tell you that it's time to exit that position. So instead of losing all the way past the pivot, you'll be able to minimize that loss. So recognizing the pattern down here at the bottom will give you a heads up on maybe trailing your stop down a little bit tighter if there's going to be a divergence. So it allows you to reduce the risk or exit trend trades that aren't going to continue in the same direction. Now we'll look at this one more time from the top side. So this divergence number 2 at the top. Same pattern, overbought, down to the 50, back to the 75, and you'll see divergence number 2, which will change the trend. Now down here at the bottom left, you'll see divergence number 2, right? But understanding that our synthetic triggers are well above support and seeing that divergence will create the opportunity for a counter trend trade long off of support. And then obviously when you get divergence at the top, it's time to get out of that counter trend trade. So divergence is a very powerful tool that can help you with entries at Fibonacci areas that are supposed to hold, or more importantly, exits at trend trades that get divergence and tend to fail after divergence. Now, one of the other uses of our fib to fib oscillator is in the background color changing. So it's another very important component of what we do, obviously, since all of our trades are predicated on the background color itself. So when our fib to fib oscillator has a value of 0 for at least 2 out of the last 8 bars, right? And you can see down here at the bottom, the fib value is 0 for 2 bars in a row. You're going to see this trend down plot on your chart, and obviously the background color is going to change, right? And just because it changes color doesn't necessarily mean there's a trade, but it keeps the background color very sensitive to what the moves in the market are doing. Now, the same thing is true for changing the background color to the upside, right? You'll notice that our fib to fib oscillator made a strong move above or at the 100 level for multiple bars. That will change the background color to up, right? And then now, remember what you already know, sideways synthetic triggers at support and a mid-band. You're going to be looking for long trades with that up color. Now, the other thing that our fib to fib oscillator will plot on your chart, and we'll have yellow dots that will represent this, is what we call sharp points. Sharp points are a phenomenon in the oscillator that tend to reverse the market at least back to the next area. So, and you'll see this in the trade setups indicator itself. You could turn these on or turn these off with input number 75 if you don't want to see them. But sharp points followed by reversal bars in price are a pretty good indication that we're going to get at least back to the next support or resistance area. Sometimes they can be a trade setup if they're from the right area. Sometimes they're just a visual clue that we're going to trade back to the next area. So here's an example of, sharp points on your fib to fib oscillator, and you can see them at the bottom and you can see them at the top. Now, these are not in line with trade setups, but as I said, this will usually get the price back to the area where you're looking to sell. Remember what you already know? Sideways synthetic triggers at Fibonacci resistance with a red background. You're going to be going short here, right? And then you see we get a sharp point on our fib to fib, which takes us back to mid-band with sideways synthetic triggers and a green background and a 25 byline on our fib to fib oscillator. You're going to be in a long position from this area, already knowing what you know. Now, there's something else that will change the background color. Our Fibonacci support and resistance areas will change the background color. So you'll see I've got two of them circled, one at the bottom, one at the top. Now, if the synthetic triggers and the small triggers agree, you're going to get an immediate color change. So up here at the top, you see an immediate color change because our small triggers are going down and they're below the cyan and white synthetic triggers. Down here at the bottom, you'll see we get fib trend up, so that's your warning. And you'll also see that the background color goes from red to gray. So basically a neutral trend. So in this case, and granted this one happened pretty quick, but sometimes you'll see these neutral zones last for a while. Once the small triggers break back above the first synthetic triggers, then it will change the trend back to up. And that's really what we're looking for. We're going to look for a couple of opportunities with the background color change, right? So we've got the first trade, the best look trade that you can get into immediately and sink your teeth into with very, very little experience and feel very confident that you've got the right areas and the right look. But we're going to go obviously a little bit further than that as we progress here. So going back to our best look trade, Fibonacci areas and trigger lines from the higher time frame charts have a very powerful effect on the market. And yes, the answer to your question is yes. The outcomes of what's going to happen are predictable, right? It's not 100%, but most of the time it's a very predictable situation. And that's what we want to do with you guys as traders, especially when you're just getting started, is put you into some very simple to read, very simple to execute, predictable positions. So the confluence from multiple time frame fibs and higher time frames and lower time frames gives us an extra edge. So we're already teaching you how to extract the best areas. So let's go a little further and let's go into some additional trade setups, right? And really we'd like for you guys to master that best look trade first, right? That's the bread and butter. That's the easy one. That's the one that you're going to be able to pick up within a day or two. right? And then as you gain a little more experience with the software and more confidence in what the background color on the software is telling you, you're going to be able to work in some additional trades, right? So we have what we call neutral zone trading. Remember where there was no color in the background? It gives us some opportunities at the highs or lows of a move to do some counter trend trading. And then because the background color is so precise, right, breakout trading allows us to take advantage of these background color changes. So let's take a look at what it looks like on a chart. Right, so the short version and the easy thing to see is the area where there's no background color. So we go from obviously buying the market with supports and synthetic triggers up to resistance. And now we recognize that because we understand that resistance has the potential to hold because of the location of our synthetic triggers. Remember that video that you watched on multiple time frame fibs and triggers, right? And if you haven't watched it, then you need to. Right, so the rules for neutral zone trading are pretty simple. We get the neutral zone, the small triggers roll over, and we're looking to sell a pullback to the small triggers that are crossed down. It gives us an opportunity to get in very close to the top or the bottom, depending on the situation. Right, and as that trade progresses down, I just put this one in here. You remember this trade? Resistance with synthetic triggers going sideways. Pretty easy to recognize now, isn't it? So whether you stayed in this trade and trailed your stop, or you got in, got out, and got back in again, right? It should be a very clear, easy read on what to do. Let's take a look at another neutral zone look. And this is, one of my personal favorites, right? We have a neutral zone, no color in the background. And we also have our small triggers crossed up, which is obviously a requirement for our neutral zone trading. And you can see the market pulls right back to Fibonacci support, which really creates almost a perfect entry for you. And you can see the market trades to the upside, up to resistance. So again, neutral zone, small triggers up, buying or selling a pullback to the small triggers. If you have a line of support helping you at that neutral zone, adds a lot of power to that neutral zone trading. All right, so let's take a look at one more picture. Again, this is one where we have a neutral zone and the small triggers roll over and we're buying a pullback to the small triggers. And you see immediately we get a divergence, so that makes you feel better once you're into the trade. And the market trades up to resistance. Now, as the market progresses around for a bit, we retest this resistance and we get a second neutral zone look, right? And as the market pulls back to the small triggers, you see that we've also got resistance from our 165 EMA here. So it creates a very nice spot where you can get a very low risk, high reward entry inside the neutral zone. And again, as I said, my favorites, when you can combine the neutral zone with a line of support or resistance, one of the better neutral zone looks that you can do. Right, now, a word of caution on your neutral zone trading, right? If you're coming off of a resistance that's supposed to hold, right, mid-band with wide synthetic triggers down, and your small triggers are way on the wrong side of your synthetic triggers, this is not a neutral zone trade that you're going to want to take. Low probability with those. So, everybody starts watching the neutral zone and their small triggers. You still have to pay attention to the location of your small triggers relative to your larger synthetic triggers. All right, so after that word of caution, here's, another opportunity. Obviously, you're going to be thinking short trades and probably take a short trade and maybe take a small loss. Right? A lot of these breakout trades, and that's what we're getting to now, will happen after sometimes you take a loss, right? Because you get a really, really nice area, you're looking to go short at that area, and unfortunately it doesn't work out. And breakout trading is pretty simple. The color changes from red to green, right? And you can see, obviously, we've got an overwhelming amount of Fibonacci support now below us in our mid band. And what we're looking to do with these breakout trades is we're looking to, especially if you've broken through an area, just a real quick pullback with the small trigger still pointing in an upward direction. And it's going to allow you to, if you took a loss over here, right, allow you to get back in with a pretty low risk. And, if the trend continues, which it does many, many times, you're going to be able to look to the next resistance for a target. So sometimes, when the market's making a strong move and you can get that, quick trend change, quick pullback, you're going to have a lot of fun with that one. All right, so here's another example of kind of breakout trading. And again, I go into this saying, yes, you probably would have had a short trade in this area, right? Resistance with the synthetic trigger sideways, and absolutely, a valid short, not as good as it could be with them above the resistance, but if you took it, that's okay, right? Recognizing the trend background color change and very quickly pulling back to support, giving you what I like to call the apology, right? You take a loser, and then if you take the breakout and the pullback to support, very, very happy with the result. Now, here's another breakout look, and it's a little bit different, right? The first thing that happens, you see the market trades up and pulls back to support in your mid bands, and you're going to have an initial long trade here, right? So that's pretty much textbook with, what we're looking to do, and that best look, kind of everything coming together trade. Now, as you trade back into your synthetic triggers, you realize you have some trouble for your long. So, small win, small loss, right? And eventually this support holds, right? And, again, watching that multiple time frame fibs and trigger video, you're going to recognize all of my synthetic triggers are well above my support. You're still anticipating that support to hold. So we get the first attempt at it, and then you're going to see a very strong small trigger, and you're going to get a breakout trade. Now this is one where you have to get in and put your stop behind your synthetic triggers and manage the position accordingly. This one's a little bit tougher to take because you don't get that pullback, and there's not, you're going to be risking 12 ticks on this breakout trade to have your stop in the right spot. So a lot of people will opt out of this just jumping in version, but you'll see this breakout look a lot of times in a very strong market where the market comes down, they meander around for a while, and then eventually get back in the direction of a strong trend one way or the other. So these trades typically are best in a very strong trending environment. And you see we had a very strong trend prior to this. So they came down, first attempted a buy, last and only attempt with a breakout to get up to the next resistance area. And again, needing to have a lot of room to the next target is key in breakout trading. I put this one in here because it's a little bit different, right? Again, a very strong trend to the downside, right? And I'm going to concede that you're probably making an attempt to buy support with synthetic triggers here. And if you do, that's okay. No harm done. It went up some. But you'll recognize the background color trend changes. My synthetic triggers are through the support area, giving me the indication, right? Again, from that video that we watched on multiple time frame trigger lines and whether fibs are supposed to hold or break. You'll see that we get a breakthrough and it pulls back and starts to touch the bottom side of our fibs. This one's not as pretty, but in a strong trending market, sometimes this is all you get. Then we trade down to support, and then obviously you're going to recognize the sideways synthetic triggers at support, and you're going to get long and make some more money back to the upside. So there's a lot of opportunities, not only with the best look, we've got opportunities inside of the neutral zone, and we've also got breakout trading opportunities for you. So no trading video is complete without a little risk reward talk, right? So how do we reduce this risk? How do we maximize the reward? So the first step is really understanding the areas that you're going to be getting into and whether you should be or shouldn't be selling or buying at those areas. So you should know where the market is going to go. Your next Fibonacci support or resistance areas as targets, and we're going to talk about stops. And then also we're going to talk about how we reduce the risk as the trade progresses. Right? Remember what we said? The key to successful trading is what? Get in with the least amount of risk, get out with the maximum amount of profit, lose a little when you have a loss, and repeat this process as many times as humanly possible in a day when they give it to you. So let's take a look at what an entry would look like. Right? And we're going to talk about the risk reward side of it. Already you should recognize that we have resistance with our synthetic triggers going sideways. Right? So you've probably had an order waiting for 4 or 5 bars already at the area to get in. Now, when we get into a trade, typically I like to keep these types of trades where you're getting in at an area to about 8 ticks risk, looking at a crude oil chart. So we're risking about $80. And notice if I was going to risk $80, my stop would be where this yellow line is, well beyond all of my resistance areas. So even if we made it to the next resistance area and turned down, my stop would still be beyond the area protecting my position. So I've got 8 ticks worth of risk. And anytime you look at going short at resistance, you start looking down at where the next supports are. So you can see our next really key support is down here at 44.50, which gives me the thought that I'm going to be risking $80 per contract to make $330 per contract. Which is a little over a 4-to-1 reward to risk ratio. That's a very good ratio. There's not a trader on the planet that would trade at 50% winners and not love that ratio. Right now, where this gets much better for us is the ability to predict these areas very, very tightly. Because if the market does what we anticipate it's going to do, which is to turn around and make a reversal bar from our resistance, right, we're able to pull our stop down above that reversal bar, effectively getting us to, sometimes 1 or 2 ticks risk, sometimes 3 or 4, sometimes 5 or 6, but effectively reducing the risk on the trade and exponentially increasing our risk to reward ratio. So remember, we already started off with our initial stop and over a 4-to-1 risk-reward ratio, right? Once we get the reversal bar, everything changes. We reduce our risk behind the pivot, and now we're risking 2 or 3 ticks. We call it 2 ticks. That puts you at a 16.5-to-1 reward to risk ratio. That's ridiculous off the charts. You can lose 70% of those and still make money. We don't want to see that, of course, but that type of risk reduction is the benefit of being able to spot where the market's going to turn and know in advance where the market's going to go. Which, if you do this effectively, I had to put it on here, right? We're going to end up with a lot of happy traders. Now, keep in mind, this was Friday at 10 o'clock in the morning, right? So many of our users in the room got this trade, and technically they got short up here inside the neutral zone, but just looking at this, best spot kind of entry with the best look. But it's going to end up with a lot of happy traders. So let's look at it one more time. This is a different trade, different setup. This is from the day before. But you see the same thing happen over and over, right? We have our trend down. We have our fib to fib oscillator back to 75. We're looking at short positions somewhere between 71 and 74. All right, so let's just call it 71. And we're going to use a tick stop. So look at physically where that puts our stop, well beyond the mid band, well beyond our indicators, giving us some room in case they overrun that area by a little bit. Now, more importantly for us, we can look down and say, wow, our Fibonacci support areas are all the way down here at 44.33. So we start off with our 8 ticks worth of initial risk, and we have 38 ticks of initial reward. That's almost a 5-to-1 ratio. Huge. Right? And this is what really happened, right? This is where we got the reversal bar. And you can see they went up a little bit further. But if we pull our stop down a couple ticks beyond that pivot, we end up with 6 ticks worth of risk. So again, 6 ticks risk to make 38 ticks. Now, I'm not going to torture you with the slide that shows you that it went all the way down there. But you know it did, don't you? Doesn't take many of those in a day to make a really good day. So here's kind of a thought for you. Okay, as you're going in and you're thinking, all right, I'm going to buy an area because I've got support and a green background and my fib to fibs there and my synthetic triggers are sliding sideways at that area, right? Think, can I buy this area and still have my risk beyond my supports? Right? And it's a pretty good rule of thumb. If your risk or your stop is still inside of some support levels, you're probably not buying the right support level. You might have to buy the next support level down or, miss that best entry. So you don't want to say, hey, I'll just risk 20 ticks because I have to, right? There has to be somewhat of a maximum, maybe 9 ticks or so usually, nothing beyond 10 ticks with the way we do this. So again, as you buy this area and the market does make a reversal, you're going to move your stop. Right? So this is what it looks like, as you're actually using the simulator and you're practicing this thought. So if you buy at a best area, you're going to have a stop down here. Right? And then once we make the pivot, you're going to move your stop up, effectively getting you to a 3-tick risk. Right? So again, you can usually move that stop up as we start to push to the upside. So again, everything that we do is about very quickly, reducing the risk. Now, that's at the edges, right? Where we're getting that best look and we're waiting for the pivot. So let's just say we've got in here, and this is kind of a hypothetical situation, but let's just say you're short. Okay, so we end up pulling our stop from up here. We pull it down behind the pivot once it makes a tail, and we're happy that we've only got a little bit of risk. And the market starts to trade down. Right? So we need to have a concrete way to reduce the risk without getting bumped out along the way. Right? So we're going to use one of two things. We're going to use these big reversal tails on the bars. Right? And we want a tail that at least exceeds the last couple bars up. So you'll see this tail actually goes 2, 3, 4 bars up and makes a tail off of resistance. So once this bar closes to the downside, and you have to wait for the bar to close, then we can trail our stop behind that new big tail. Right? So then you leave your stop there and you just relax. And the market trades down, and then it pulls back up to, our mid band, and then only after we get that next down bar can you trail your stop behind the next pivot. And then the market trades down, and then the market comes back up, and then the market finally makes another down bar. Then we can trail our stop behind the pivot. So it allows you to not get bumped out on every twist and turn in the market, and you're allowing the market to trade from one area down to your Fibonacci target. Sometimes they come back and get you, and if they do, that's okay. If you have another trade set up, get into it. If you don't, you'll wait for the next trade setup. So very simple money management techniques. If you're getting in at the area, you wait for the down bar and trail your stop behind the pivot. And then along the way, big tails or new pivots to the downside, trailing your stops behind those. And that's going to keep you in most trades most of the time to get to the next target. So again, no trading video is complete without what? A little bit of money talk, right? So, this is a sheet that one of our users put together, and it just gives you a couple of real simple ideas, right? If you make $250 a day on one contract, and you can see that, getting in at those best spots and getting in at those tops and bottoms and getting in on those breakouts are going to provide you with the opportunity to make at least $250 a day on average, right? Most of the traders who have really gotten good at using our software average considerably higher than this. But if you use this as a base, if you trade 20 days a month, right, and you make $250 a day average after cost, you're going to make $5,000 a month, right? And you can see very quickly as you get to 2 contracts or 4 contracts, just averaging 25 ticks a day per contract is going to give you quite a bit of money. So again, the money will grow. I don't want you to worry as much about the money in the beginning. I want you to worry about reading the software properly and using the tools necessary. So here's my personal mission for you. And if you know me, you know this is true already. And if you don't know me yet, you will know it's true. Right? I want to give you 100% confidence that you know exactly where the market's going to turn and why. Right? Because when you know it and you feel confident about it, you're going to be able to trade it. I want to teach you, and I've already taught you in this video, but I want to show you live in our trading room as well, exactly where to get in with the least risk possible and how to manage the trade from start to finish, right? I think I've already accomplished that. You've got to go through it and see it live and do it 100 times and you'll feel comfortable with it yourself, right? So, and then the second half of that is knowing where the market's supposed to go to our, once you get into a trade. So making the most out of your trade with trade management rules and using our Fibonacci support and resistance areas. And more importantly, this method is not for the gifted few, right? You don't have to be a rocket scientist. You don't have to be an experienced trader to do what we do. You don't have to have $100,000 in trading capital to do what we do. This method is something that's simple. It's very visual. You will know immediately where those best spots are. You'll recognize and build confidence using those best trades. Then as your confidence grows with those best trades, you're going to add on breakout trades and you're going to add on neutral zone trades. And you're going to really have a very well-rounded out plan. Now, simple educational path that we take everybody down, right? We like for traders to mark up and go through history and take pictures of the trades, right? And make your own folder with the pictures that you see that fit the rules. This step allows you to kind of do what I just did in this video, is to make these pictures and build the confidence in seeing the setups. The second step will be to use a simulator. And we have a live class where as you simulate, and I promise you're going to make mistakes. That's the purpose of the class, right? It allows you to act upon your education, to push the button, to place the stops, to put the targets in, to manage the money on simulator while you're learning. And it's during this simulation you're going to continue to build confidence. You're going to continue to work through any mistakes you might make. And posting these charts in our educational room, I will give you feedback on how you could have done it better, or if you did it perfect. And then ultimately, we want you to trade live money with your plan and your confidence following the indicators that we've put together. If you want an example of a basic trading plan and a little more in depth on that, again, from our education page on the website, these first two videos that are on there, these are the two that I want you to watch, right? Indicator basics and Fibonacci reading with the trigger line lesson. So make sure you watch these two videos. If you've ended up watching this video before these two, you got to go back and watch these two. And most of these videos that I do, it's better if you watch them 2 or 3 times. Now, again, the other thing that you're going to see is we're going to put you into our educational room. And you're going to be able to post pictures, and we're going to be able to look at the trades that you've done. So you're going to use this camera down here, and you're going to click on your charts after you make a trade, and we're going to be able to talk about what you did right, what you did wrong. We're going to really work you through the learning process. Right, so ask yourself, do you really want to learn to make money? If you're serious about day trading and you're serious about money, our software is going to give you the information you need to be accurate and, more importantly, be confident in your read of the markets. And maybe even more important than great software is great hands-on real-world education and training. That in and of itself is worth the cost of admission. So we already have an exact educational plan, takes you through the setups, takes you through working with simulator, and takes you all the way to learning real money. We just need you to be serious about it and get started with it. So once you purchase software, you're going to get a lifetime subscription to the indicators. We're also going to give you 6 months in our live educational room. So we're not going to sell you software and kick you out the door. We want you to stick around, and we want you to participate, and we want you to hone your skills with us. And more importantly, we give free demos of our software, and we're going to teach you how to be successful before you even have to purchase. So if you haven't done so already, take the time, go to nextgent3.com, sign up for a demo of our software. I think when you run the software and you spend a week with us in our class, the outcome is undeniable. You're going to absolutely know that you're going to be able to build confidence, you're going to be able to build a great trading plan, and you're also going to be able to execute that trading plan with consistency. So I look forward to seeing everybody in our room. Look forward to continuing your quest for profitability trading the market. And I really appreciate your time watching this video. Thank you, everybody, and we'll look forward to seeing you soon.